Great. Welcome, everybody. Thank you very much for the time and hearing what we have to say. We really appreciate it. As Yardena said, this is being broadcast live on Facebook and it's being recorded, so it'll be available. If you feel it's relevant, you can share it with whoever you like. At any time, you can post a question via the Q&A, and we'll try to get to it either during the presentations or after. My guest is Kfir Yagour. Kfir is part of Ion Asset Management. Ion are one of the grandfather firms in Israel in the hedge fund or equity selection space. We've known Ion a very long time, and Ion manage about $1.3 billion in 4 very similar strategies, all with a specific speciality of stock picking. Kfir, together with Shimon, even though Kfir has been with Ion since 2007, Kfir with Shimon Potter launched the Ion Tech Fund in 2018. And in a bit, when I'm done, Kfir will tell you a little bit more about that strategy in a bit more detail. Okay, so then you can start my presentation. I'm going to just give you a little bit of a macro view on how we see the world. I see there's some common names. There's some people who attended last week's presentation, so my macro view hasn't changed that much, or if at all, in a week. I will say that our frustration grows, even though we're very optimistic about the situation in Israel and the fact that our virus numbers are improving so much. We're still frustrated with the masks and the procedures. And I feel that these are not going to last very long, because you can imagine thousands of people arriving at a place of work and the delays that it will cause if you have to measure everyone's temperature and insist that they wear a mask in public places. It's very, very difficult. So we're optimistic, but the situation is kind of frustrating and a bit strange. All right, so let's just jump into the macro. Yardena, slide. Let me see. Okay.
You have the controls.
Okay.
Wait,
Oops.
wait. So wait. Mike?
Yeah.
Let me just put you back on. Yes, great.
Okay, and page down. Great. Okay. So obviously we have very high levels of uncertainty, both in terms of the virus and in terms of the economic consequences. We don't yet know how long this partial lockdown will continue in the major developed economies. We don't know when a vaccine will come. We don't know how quickly the economies will rebound, how quickly companies will re-employ. And the high levels of government intervention have certainly helped in every respect, but we're still battling to understand the consequences, and I'll deal with that in my presentation. A new phrase which has come out, which I've read in a research report this week, is a phrase called New Normal 2.0. And that refers to post-2008, we use the word new normal, where we have high level of government intervention in the market, high level of uncertainty. And we said, okay, well, that's going to cause volatility, and we have to get used to a high level of volatility in the market. And that was the new normal post-2008. And now they're calling it New Normal 2.0 because it's all of that plus more enhanced. So there's a higher level of government intervention, higher level of uncertainty, higher level of political consequences. And that's the phrase that the investment people are using now to explain the situation that we're in. The key investment question that's on my mind every single day, would you rather be early or be late? Would you rather be early and take the risk that things are not as they seem or not as optimistic as they seem, if you feel they're optimistic? Or would you rather be late, wait until this period has passed before you start investing seriously? And that's the essence of the question. Why doesn't it change pages? There we go. Right, so let's just review the markets so far this year. You can see the red line is the NASDAQ, the blue line is the S&P 500, the green line is the emerging markets, and the red line is positive year to date. The S&P, I would say, is showing a modest loss of 7.7%. EM is showing a meaningful loss of 17%, but that's influenced heavily on the positive side by China, and Russia are surprisingly only minus single digits, whereas Brazil and India are minus 30 to 40%. So there's a big gap between which emerging market got hit. And if you go take a 12-month view, you can actually see that nothing's really happened from a stock market point of view. If you closed your eyes last May and opened them yesterday and you didn't know that we'd had this corona, you actually wouldn't, you'd be like, okay, so I've made, nothing's happened. And you can see that the S&P is positive 7.5, the NASDAQ is plus 30, and the emerging markets are minus 5. And this is only a 12-month view. I normally show, when I show what's happened in the market, you show a 30-year view or a 20-year view, and you can see powerful returns over a long term. But this is only 12 months. So we have to ask the question, do the markets fully reflect the economic collapse that's happening out there? And in my opinion, I would say there's a big disconnect. There's a problem. I think that the markets are not fully reflecting the economic damage that's out there. And we have to analyze why are markets so relatively high. So firstly, there's the long-term constructive view that says sooner or later we're going to have a recovery. There's a fortune of money seeking returns. We knew this before Corona. We knew that because interest rates were relatively low, especially outside of the United States, there's no interest in Europe, there's no interest in Japan, there's no interest in Israel. So there was a huge demand for risk assets, and we saw that, right? And there's also a lot of long-term money in the market that is not really fussed whether the market is high or low, and that gives support to the market. So that's a sort of long-term constructive view. The other reason why the market is so high is policy. There's a massive amount of credit and money creation, okay? So that means that the Federal Reserve is creating money. Most of it is digital. There's the press like to use this phrase, printing money, for quantitative easing, and I beg to differ. When they buy bonds, they're creating money digitally. It's not the same as printing and handing out money. They are printing more money physically, but that's small relative to the quantitative easing steps of buying bonds. That's a book entry in the government, and it just creates a huge amount of liquidity. And you have to ask yourself, the simple question is why? Why are they doing this, and why is this such an important part? Having lived through 2008, the banks, the government realized that the banks are the spinal cord of an economy. If the banks fail, everything fails. If your financial system is not stabilizing your system, then you're in real trouble. And so they have to. The alternative of not providing support and not buying these bonds is complete disaster. That's a financial crisis on top of a health crisis and an economic crisis. So they realize you cannot have a financial crisis. They're supporting the amount of credit out there, and that makes the financial system much stronger. Banks are willing to provide loans. People with assets are not feeling major losses, and everything carries on. And now it's time to get the real economy going. The excess cash created by this policy is being reinvested in the market, and that is providing a lot of support. In addition to the monetary policy, there's also fiscal life support in the form of tax relief or tax discounts and helicopter money. That is, every United States citizen, even those who live in Israel, received a stipend of a few $1,000s or whatever it was, and it happened really, really quickly. So both the quick monetary response and the fiscal response happened really, really quickly, and that's why we see that in the market. Another interesting thing in the US is that the virus, the hotspots of the virus, you might say Los Angeles and New York, but the United States is a really big place. So you've got certain states that are getting massive amounts of federal support and money because it's at a federal level that those loans, but the actual virus damage in some of those small states is minimal. They never had a full lockdown. They never had well, they still haven't had major virus numbers, but they're getting all this money. So that's another positive behind the markets. Okay. Us as asset managers, we're left with this dilemma. Do we add risk to our portfolios or not? On the bear case, the April rebound is a classic bear market rally, which precedes weak market. So it means that there was a bit of a bounce back and there's going to be a recession or worse, and we should not pay too much attention to that bear market rally. A lot of the data that we have is Q1, and we all know the real damage is Q2. So Q2, we're all guessing how bad are things going to be, how deep is the shrinkage of GDP, and that's guesswork. So in addition, another point, internationally, government support is much weaker than the USA. Europe is stuck in, well, it's slowly getting out of, but many countries of Europe are not getting the same support that the US gave themselves, and a lot of other countries are not as quick as the USA. There's obviously the threat of a second wave of the virus or an extended lockdown, or that this virus stays with us for a number of years and pushes out the problem, and that would be bad. And then there's structural changes that follow. For example, how quickly does a company re-employ? There's 36 million people unemployed in the United States. How quickly will they be re-employed? Then, of course, there's the political consequences, the China-USA tension, which is so much higher. Ironically, in 2018, when Trump launched his trade war against China, we saw the market reacted terribly. The tension now and the things happening between the United States and China now are 100 times worse than that, but the market continues to go up. You know, they passed a law in the US about transparency of dual listed companies. Chinese companies listed in the United States have to do certain things now, and they risk being delisted. These are types of things which 2 years ago we never thought it would get this bad. And of course, the last point on the bear case is that the dollar can weaken significantly because of all this monetary policy. On the bull case, which is the optimistic scenario, low interest rates support equities, so there's going to be a ton of money seeking returns. You could say that the analyst estimates for Q2 have already priced in the pessimism of Q2. And the government support, as big as it is, with their promises that there'll be more, is actually big enough. And it'll help the companies get through the bump, and we'll get back to business sooner rather than later. Fiscal expansion with low rates should be positive for equities. And if there's inflation, and I'll discuss this specifically, inflation is positive for real assets and equities. So that is why you should be invested if you're such a way inclined. The issue of inflation, this has come up in a lot of conversations with clients lately. They say, well, there has to be inflation. There's no ways that they can create so much credit and so much monetary policy easing and fiscal expansion without inflation. It's just intuitive that you think that there will be inflation. But however, there are some counter arguments, and we may not see inflation spike anytime soon. It might be a consequence for down the road, a couple of years down the road. But right now, we don't think that inflation, I personally don't think that we're going to see any major uptick in inflation in the short term. Just to touch on a few of the points of why I think that. So the arguments in favor of inflation, as I said, aggressive increase in money supply, that is historic, traditionally that's an inflationary thing. In 2008, when they did monetary policy and bond buying, it was like very much in the financial world. It didn't trickle down to the man on the street. Whereas now the size of the moves are going to trickle down to the man on the street, and that should be inflationary. Less globalization, meaning companies pulling out of China or shutting down or protecting their local industry to create jobs, that means higher prices. Higher political risk, higher prices. Health control procedures. Every time you need to employ somebody at the door to check your temperatures, there's all this inefficiency through the health control. If you're going to have an airplane, you can't fill it like you used to. If you're going to have a theater, you can't fill it like you used to. So that means it's more expensive airplane tickets and more expensive show tickets, etc. And what would you do if that's what you thought? You'd invest in gold and equities and property. Arguments against inflation. There are, everyone knows the oil prices fell through the floor through excess supply. So we've got a massive shock from excess supply. Okay, manufacturers are sitting on too much product. Your retailers are sitting on too much product. The only way to get rid of those products is to push down prices, like we saw with oil. Technology historically has been a very strong force in keeping inflation down. And there's simply too many people unemployed. How can you have inflation with so many people unemployed? I don't know. If you don't think there's going to be inflation, then bonds is what you should be investing in. To summarize, what you should do, focus on your long-term goals. We're optimistic for the longer term. I think we will get over this thing, and more cautious for the shorter term. So our portfolios are a little bit underweight risk than they would normally be, certainly compared to our benchmarks. We're fully invested in the bonds. I think bonds do offer value, especially in fact, all bonds I think are worth their allocation, and especially compared to cash. Then on the equity side, we'll wait. We're patient. We do have equity exposure, but we're going to just wait and play it out until we're full equities. Don't bet against the USA. That's for a dollar thinking client. That's certainly something you have to, you should keep your dollars, I think. The dollar may weaken, but I think the whole world is going to weaken. So on a relative basis, we may not see the currency volatility that is expected. And we think that you should look to increase returns post-corona in a smaller set of alternatives than you would have last year. Last year, property, consumer credit, lending, these type of things were much more popular. Post-corona, it's a narrower set of alternatives. We like structured notes, and we think that specialist funds like Ion Tech have a place going forward in a post-corona world. So on that, I'm going to hand over to Kfir. Yardena, you can stop sharing. And thank you very much. Please post any questions on the Q&A. Thank you.
Hi, can you hear me now? Okay, so good afternoon, everyone, and thank you, Mike, for the introduction. I'll say a few words about myself and about Ion Tech. So my name is Kfir Yagour. I joined Ion back in 2007. Years ago, we launched Ion Tech Fund. Shimon Potter, my partner, and myself. Ion Tech Fund is a long-short equity hedge fund focused on global technology. What we do here, and it's the same since I joined Ion 14 years ago, is fundamental research, delving deep into every company we invest in. We think long-term, and we we manage a very concentrated portfolio that consists of 15 to 25 names top. That's the way we work. So I'll start with a slideshow presentation, and then we can move to Q&A. So let me take you 100 years back, 1920, when Coco Chanel, the French fashion designer, stepped off a yacht and was photographed with a suntan. Back in the days, it was a big thing. Back in the days, in 1920, sunbathing was associated with manual labor, like working in the field. And in turn, it had a racial subtext to it. The photographs of Coco Chanel coming with a tan had a big impact. A tan became beautiful. It became attractive. It was even desired. So, I mean, you can argue that Coco Chanel invented the sunbathing. So when we enter month 5 of coronavirus consciousness globally, the world is full of prediction, you know, how the futures will be. Some argue that some things will never be the same. And we agree to some degree. Today, surely no sensible CEO will place thousands of employees in one physical location again, right? Nor it will be caught off guard when it comes to work from home policies, and procedures. For many, you know, the idea that there's an event like Corona that changes everything is very appealing. Because, you know, it's easy to understand. There's a shock and everything changes. And when it comes to fashion or style, like sunbathing, it could be the case, it could be true. An overnight change could happen. However, when we think about things that genuinely change the way people live and interact with each other, it's more difficult to change behavior instantaneously. Like, for example, cigarettes, okay? Since the early 1960s, we know that cigarettes categorically reduce life expectancy. And yet, until today, millions of people globally smoke. So what made sunbathing became so appealing, while quitting cigarettes failed poorly? What's the difference? So clearly, there are many ways to model and think about changes, right? So there's one guy that I like. His name is Michael Parker. He's from Bernstein. He's the Asia Pacific Equity Strategies. And he argues that basically it's the fun factor. The fun factor is what divides behavior that changes overnight from behavior that persists. He says if the existing behavior is fun, it will last. As simple as that. No, it's not complex. When you think about, like today, when you think about public congregation, right? You have supermarkets on the one hand, and you have bars and nightclubs on the other. In both cases, you are surrounded by strangers, right? Yet supermarket experience is not necessarily fun. And it's not that it's not fun. Second, there's an alternative. You can do online grocery delivery. However, when you think about the bar, when you think about the club, the concert, the experience itself is fun. You want to be surrounded by those strangers. They are sharing the same vibe, same energy like you. So according to this logic, and this is one logic, physical supermarkets are at risk, while bars, clubs, concerts are safe. We think a bit differently at times. I mean, we're not that sophisticated and we don't have sophisticated models or algorithms. What we do is we use two things. A, all the data we have available. Actually, it's public data. Each one of us gets data from the news and from companies' earning reports. There's a lot of valuable data in companies' earning reports and conference calls. And B, we used our common sense. The framework we built is basically dividing the changes into two categories: cyclicals on one hand and seculars on the other hand, even though sometimes it's a mix of both. So we define cyclical changes as temporary changes that will fade away once coronavirus has passed. It's only temporary. This is the category we will include the beleaguered restaurants, hotels, airlines, cruises, live events, cinemas, theme parks, gyms. All of those, as we see it, those are temporary changes. when we define the secular changes, we think about permanent changes that either began pre-COVID-19 and got a boost from it, or were initiated during COVID-19 and should stay with us for years to come. Under this category, we include trends like e-commerce, e-learning, content streaming, digital health, and telemedicine. Also online presence for SMBs and work from home. All those, for us, as we see it, those are part of longer secular changes that are going to stay with us. There was an interesting interview in the Wall Street Journal with Walmart CEO. He was talking about the changes, and he was saying that many of the changes seen in consumer behavior will be permanent. And that's very, very important. Walmart, in the last quarter, they saw 74% increase in e-commerce year over year. And when we talk about online grocery ordering, they saw 300% increase year over year. However, I think that one of the biggest indicators that a true shift in habits that could come permanent is the fact that Walmart, fastest growing group of e-commerce, is consumers over the age of 50. This is important because typically this is a very stubborn group. And if they order online, it means that we have a real change, structural change. Another thing, last week, Mark Zuckerberg announced the company is aggressively leaning into hiring remotely in response to COVID-19, aggressively. Facebook expects that half of its workforce, tens of thousands of people, employees, may be permanently working remotely within 10 years. 50% of Facebook employees will be working remotely in a decade from now. I think that's an astonishing number. So when we combine everything, like what Facebook said, when we think about the world where more and more people are working remotely, more people are working from their home, we imagine a world where cities lose their power and attraction. I mean, we're talking about deurbanization. The trend reverses. More and more people moving out of the city into the suburbs and to rural areas. And it means that demand for commercial and residential real estate might decrease, and real estate prices will follow downward. And at the same time, the need for cars is reduced dramatically, which because commuting is less necessary. So, I mean, this is one scenario, and we can go with different views on this. So, and I mean, maybe it's an extreme scenario, and it might not even happen, or it will take years to pan out. But that's how we think, and we don't ignore that. We keep it in the back of our minds, and we try to keep it like, we try to think about it when we think about investing. Now, let's dive into some specific examples of stocks, and how we at Ion Tech think about each one. That will help you understand the way we think and how we analyze companies. So the first one is Zoom, because everyone knows Zoom, right? We're using Zoom right now. I mean, but it wasn't always the case. Zoom, the full name is basically Zoom Video Communication, is the poster child of the winners in the coronavirus era. It's like the classic, the right place at the right time with the right product. Zoom has lived from being an unknown technology company to a household name within merely 2 months. I mean, in 2 months, everyone knows Zoom. My kids know Zoom. My, grandmas know Zoom. Everyone knows Zoom. It was April 22nd when Zoom reported that they saw around 50% surge in daily users. They passed the 300 million daily meeting participants. 300 million daily meeting participants, amazing. And you know, at the beginning, Zoom, the use case for Zoom was business meetings, right? But then it went into school lessons, e-learning, yoga classes, dance party, poker games. It was even used for the first time ever to choose a jury in a trial in Texas. And I don't think we have to go too far. I mean, I'm sure that some of us were Zooming Lela Seder with our families like a month ago. So everyone knows Zoom. Now, when the world grapples with the new reality of social distancing and productivity of less travel and less person interaction, we expect, I mean, it's not, you don't have to be a rocket science. It's not rocket science to understand that Zoom is going to be a big beneficiary for years to come. There's no argue about it. However, when it comes to valuation, it's become a little more trickier. Why? The stock had a huge run. The stock rallied 150% year to date. So we decided, like, let's see what the stock bakes in. It called, or we call it reverse engineer the stock price. Let's see what top line growth would be needed in order to justify the current share price. And what we got was that basically the company need to grow its revenues by 50% per annum for the next 8 years. The company needs to grow 50% every year for the next 8 years in order to justify the current share price. We call it priced for perfection. I mean, that's the blue sky scenario, right? This is beyond our ability to make a call. We don't think that we're smarter than that and we can be more bullish than that. We prefer companies with a better risk-reward profile. So in Zoom case, no argue. This is a great company. It has years of growth ahead. However, at the current valuation, it is not for us. We passed on Zoom. However, if we go to Fiverr, I'm sure that some of you know Fiverr, but I'll say a few words about the company. Fiverr is the biggest online marketplace for digital services. It's basically an e-commerce platform that connects businesses and individuals on the one side, the buyers, and on the other side, the freelancers, which are the sellers. It connects buyers and sellers in businesses with freelancers. I mean, think about like small gigs, like you want to design a logo or business cards for your business. So what you can do, you can spend valuable time running around looking for a local designer. You can talk to your friends, colleagues, to find someone. But instead, you can just go to Fiverr, browse through the catalog, and find the service you need. What amazing is that the average time to purchase a digital service on Fiverr is merely 15 minutes. In 15 minutes, you get your service. That's quite amazing. Now, the way they build the platform, they built it, it's called SKU. I call it SKU style platform, exactly like Amazon. Even though those are digital services like designing a business cards, they clearly defined and priced every service the same way of a physical product like a bottle of water. So it's a very intuitive and easy platform to use. And if we now going to, when we think about the business itself and the trends, Fiverr was showing acceleration in the business even before COVID-19. The results were amazing for a few quarters now, even before the whole coronavirus started. Yet once shelter in place became the norm and social distancing, took place, when it started, Fiverr saw a huge spike in traffic into the website, into the app. So previously we thought, okay, this company is like growing amazingly, 40% plus, 40% top line growth. And we thought that the company could be break even by year end. This is way ahead of what the market expected. Now, after COVID, we see the impact of COVID-19, we think they can grow even 50%, I would even say 60% year over year, and become profitable even earlier. There are not many companies that grow 40, 50, 60% top line and are profitable at the same time. So this is a unique asset. We also believe that the last few weeks gave a boost to Fiverr brand recognition. It was improved dramatically, and this should help them. This should support growth for years to come. And the growth is important because it also starts what's called the network effect. The network effect, which is very important, especially with e-commerce, is that when more buyers attract more sellers, and more sellers attract more buyers. So it's a virtuous circle that could make an e-commerce a winner. It's a winner takes it all market. So we think that Fiverr has the potential to be a long-term winner, a real winner. And it is no secret that Fiverr was one of our top performer stocks over the last few weeks. Last but not least is PayPal. I think that's a brand that most of you know as well. But I'll say a few words about PayPal. As we see it, PayPal is the online payment company. PayPal processes 20 to 30% of all e-commerce transaction volume globally. 20 to 30% of all e-commerce transaction volume globally. It has 300 million active accounts on the platform. It has 25 million merchants using the PayPal checkout button on the website. Consumers love PayPal because it enables hassle-free, one-touch checkout across millions of online merchants. And merchants love PayPal because it drives higher sales. That's it. It's as simple as that. And if you look at the chart, you'll see that the average increase in the last decade, the average increase in e-commerce penetration is roughly 1 percentage point per year. To put it into context, it took a decade for US e-commerce penetration to increase by around 10% points from 5.6% in 2009 to 16% in 2019. Yet, in 8 weeks, it took for the next 10 percentage points to happen. From 5.6 to 16, 10 years. From 16 to 26, 8 weeks. This is amazing. I'll share with you a few more strong data points that support e-commerce. MasterCard and Visa both reported a more than 40% growth in e-commerce during April month. Also, in Latin America, 2 out of 10 credit card and debit card users shopping online were doing so for the first time ever. 2 out of 10 users, credit card users, were doing that for the first time ever in Latin America. This is wow. In April, PayPal saw an acceleration in active accounts, 135% year-over-year growth. they enjoyed 250,000 daily net active accounts. 250,000 a day. And I want to quote a part from PayPal conference call, just to get the magnitude and the trend. Governments, regulators, and merchants of all sizes are now approaching us to include PayPal and Venmo and in-store checkout in order to help enable a safe checkout experience. The need for contactless payment is more important than ever before as consumers and merchants move away from handling cash or touching keypads while adhering to strict social distancing requirements. PayPal is one of our top 10 holdings. We like this story very much before COVID-19, yet we like it even more today. We think the company is well positioned to ride the secular changes of shopping moving from offline to online and payment shifting from physical to digital. PayPal is a long-term winner, and we love long-term winners. I can say that. At ION, we have years of experience. And what we learned is that our strength lies in analyzing secular trends correctly and calling the winners. We were never brilliant in calling shorter trends. Therefore, we put less focus on when gyms will be fully reopened and put more focus on how the world is going to look like in a couple of years from now and who will be the winners and losers in that world. Those are the standards that guide us when building our portfolio. Today, we have in the portfolio 15 companies, long and short. I would say that 2/3 of the names of the companies we hold are coronavirus beneficiaries, like Fiverr and PayPal. The other 1/3 are practically long-term coronavirus immune. So thank you. I'll be happy to take your questions and in any direction.
Thank you, Kfir. I got one question before it was received here, and it was in relation to the United States election, and will we be changing our investment strategy leading into the election? The truth is that the election has taken a bit of a back seat because of the virus. It's taken precedent over the election. Obviously, it's there. If things carry on as they are, our base case is that Trump actually is re-elected, and he would be the first US president, I think, since 1901, who would be elected when there's been a significant downturn in the economy in the last 2 years leading up. He would be the first time since in 110 years. So that's our base case. Even if Biden comes in, given the state of the economy, it's unlikely that he's going to be doing anything major. He might bring up the Obamacare story again, but I think that given the turmoil of this year, I suspect he will take a market-friendly approach. So no, I don't believe we'll be changing our strategy for the USA. In fact, quite the opposite. We're driven by don't bet against the USA. So in a dollar portfolio, we really feel that they'll figure it out. And I don't think that Biden is a risk to the market like Bernie Sanders or Elizabeth Warren would have been. Right now, regardless of your politics, the US, and there's going to be a lot of finger pointing and a lot of grandstanding. The White House, the Senate, and the Fed have actually done a good job in the economic side of this virus. You can criticize the way they've managed the lockdown or not. You can criticize the various complexity across that. With the United States, actually 50 different countries, each with their own lockdown policy. It's very confusing in that respect, but the government has actually done well. People got money in their bank accounts, companies have got loans, all done incredibly quickly. And that is an impartial view. But there will be mudslinging, right? There will be a lot of criticizing and the finger pointing. But I think that our base case is that Trump takes it. But if we're wrong, and we've been wrong on political calls in the past, they're impossible to call, I think that Biden would take a market-friendly approach. Okay, and there's more questions. Hold on, let's see. Both of you seem to believe that the real estate prices will go down. Could you please develop a bit, especially concerning luxury real estate in Israel, like Kfir Yagour, Savion, and Herzl Couture? Wow. I think the property market in Israel is a complex thing. I think that there's a lot of sensitivity around the high end. The neighborhoods that you mentioned and the large houses, I think there's a lot of sensitivity there. The risk appetite for those type of purchases has pretty much disappeared, and that was before Corona. The last 12 months, the high-end property market has been exceptionally weak, whereas the demand for apartments is much stronger and less sensitive. So I think apartments will be okay. There's a tremendous amount of new building coming online, new apartments coming online, and I'm a little concerned that some of those builders and property entrepreneurs are going to get caught holding empty apartments, because a lot of risk appetite has disappeared and people are not so quick to buy expensive apartments. So that's my personal take. And given the interest rates are going to stay low forever, I've never been a big believer that interest rates directly affect property, but I do think interest rates will stay low, and my property friends and my property clients are going to kill me, but I think we may have seen the peak in property prices for a while. I don't know, Kfir, if you want to add anything.
It's true that I mentioned that's a scenario, but we try to focus on technology, so I wouldn't make any projections.
He's cleverer than me. He knows not to make a call. But I just think the high-end space is all over the world. New York is going to really, really struggle in a post-corona world where there's more remote working, people working from home. You don't need, I think the high-end property market is definitely going to suffer. And then we've got another question. Hold on. Is now the right time to start investing, in your opinion, or is it better to wait till the full picture evolves post Q3? Okay, so this is the dilemma. And as I said in my presentation, do you wait, or are you too early or too late? You're not going to time it right, that's for sure. But I certainly feel that there's a lot of value in the bond component, and in private clients, that's typically a large component of their strategy. Investment grade bonds, not much risk there. Certainly a huge premium over cash. So I would start building a portfolio on the bond side. Even the riskier bonds like high yield bonds and emerging market bonds and subordinated credit and fancier bonds, even those places, your expected return is so much higher that it's worth taking the risk in those places. The equity market is the equity market. I think that it's very difficult to call, impossible to time, and one has to average in. If a new client joined us now, we would do exactly as we did a year ago or at any other time, is we buy the conservative assets quickly and the riskier assets a little slower. So, not because we saw Corona coming. If a client joined us in January, we bought all the conservative stuff quickly and we averaged in. And because of that, they avoided the shock of February, March. So one never knows, and you just have to average in on some basis, in my opinion, because you won't be able to call this correctly, in my opinion. I don't think anyone knows when the comfort will fully return, so that's it. Start with the conservative stuff and then average in on some basis. You can decide slower or longer, but averaging in always helps ease the anxiety of taking risk. Okay. We've got another question here.
I can say something about equity. We don't think we can really call the markets. I mean, that's beyond our capability. We have our view, but our strength is in stock picking. Basically, we choose businesses that we think that over the long run, beyond a month or two, can prosper and win over the long term. So obviously in times like that, we make sure that every company in the portfolio has the balance sheet to go through a rocky ride, or if there's going to be a second wave, that we want to make sure they're going to survive. But we want good companies with strong earning power, strong pricing power. We want companies that during the crisis will increase market share and come out of that even stronger. So that's how we think about companies, and we try less to call if next month we're going to see a correction or we're going to see another rally up. And obviously it's I'm not sure anyone knows. You showed the bears versus the bulls, and the debate is ongoing. So we try to focus on good companies and the long term. In the presentation, I showed some examples, but we have more that if Trump is gonna elected or someone else, it won't change the fundamental, the investment thesis that we see for the next 3 to 5 years.
And just to that point, Kfir's answer highlights the difference between the way that Ion think and the way that Pioneer think. We're more of asset allocators, and they're specialist stock pickers. And that's why we complement each other in a way, because we're focused on the asset allocation decision. They're focused on the individual company selection. The last question we got here is, what is our view on Slack? And I will let Kfir answer that one.
Oh, okay. Our software analyst did some work on the name. There is no argue Slack is a brilliant company. I mean, their solution is, when we talk to clients and we do channel checks, it feels like it's a cult. People using Slack, it's a cult, which means that it won't easy for even the mighty Microsoft with Teams to take over that easily. We never felt comfortable with the valuation. We didn't have a strong enough view to pay the very high multiples of where Slack is trading. However, it's a name that we wouldn't short, because the way we think about, at least shorts, when we go against companies or think that we can make money from falling stock prices, we don't short good companies. And Slack is a brilliant company. It's all about how much you're willing to pay for that. So I don't have much to say about Slack. I can just say that it's too expensive for us. The same with the Zoom. Sometimes you have brilliant companies that the valuation is running ahead of the business. We're looking for businesses that the valuation, that they are undervalued. We think it's a great business that the market misses the opportunity or doesn't really understand the size of the opportunity. In Zoom case, in Slack case, I think that the market is maybe the market is realistic, but if I had to bet, I think they're overly optimistic about the prospect for the next few years. I mean, I just want to give one example. We have Sienna. Yeah, in the portfolio, it produces equipment for telecom equipment. It's a telecom equipment company, and I'm saying it doesn't matter if Trump being elected or someone else. It doesn't matter if Corona is going to be be short-lived or not. Over the next few years, there's going to be a big cycle, investment cycle in infrastructure. During the coronavirus, we saw that YouTube and Netflix are lowering the burden on the networks because they can't really contain all the data that goes on the networks. We know that with all the data, with all the data centers that are being built and will be built, we think that Tiena is the winner. So those are the kind of companies we like to buy. It trades at around 15 times price to earnings. We think that they could grow earnings at 20% plus. That's a reasonable valuation for us. Not buying a company like Zoom at 50 times sales next year, 50 times revenues. It's way beyond our ability to really price those companies. We like down-to-earth companies that we can do the reasonable model and don't have to call 2029 in order to make a decision.
Here we got a question here. Are there any hot Israeli tech companies? I suppose that means the next Waze or I don't know, I guess Fiverr probably fits that description.
It depends. If you talk about the private market, then it's less our area. We focus only on public companies. So we read the news like you guys, and we meet a lot of private companies, but I wouldn't recommend on a private company. On the public side, we are focused on global technology. It means that we can hold Israeli names as well. However, the universe is huge. Fiverr is one of the names that got the portfolio because it's really a unique asset. By the way, I met Upwork, I met freelancers.com. One is a US peer, one is an Australian peer. Both of them are publicly trading, and I can say openly or with no, I can say that they are no match to Fiverr. This is a really high quality company. The management is quality. The DNA of the company is real technology, and we like it. Another Israeli name that is in the portfolio today is SolarEdge. SolarEdge is related to the solar energy world. However, it's a technology company. The products they made are based on technology. The DNA of the company is technological. So this is another name that we like. It's not an emerging name. It's public for a few years. Great management, great markets, great products. We like for the long term. We don't deal with tiny Israeli technology companies because usually it's illiquid. We like to have a portfolio that is very liquid, that we can get in and out quite fast. So I don't have an emerging tiny name that is going to be the next.
We got quite a lot of questions coming in. I'm going to take one more and then we're going to close. The question is, with a second wave of COVID expected in the second half of the year, is it a good time to invest at present? Wow, if a second wave happens, that will be bad. If it's a genuine second wave and not a spike. But if you look at the countries that have had COVID, the Asian countries, Israel, Italy, even Switzerland, you can see that there's a significant reduction in active cases, and these economies are opening up, but the numbers are coming down. So there is a wave, a big question mark about the USA and how they get from 1.2 million active cases down to a reasonable number. I'm kind of basing that on the model of the other countries that have had it and are a month or two ahead of the United States. So yes, it's a risk, it's a concern, but again, we're not going to call it all or nothing. It's not a case of yes, we're going to wait for a second wave, or no, we don't believe there's a second wave. We're going to continue with our short-term cautious approach, which is not to have all the risk on the table at once. So I hope that answers the question. With that, I'm going to close. Thank you, Kfir, for the time. Thank you all for the time. I hope you enjoyed. Please feel free to email us. I'm very, very happy on this call. We've got people from all over the world, from Miami, from South Africa, from Israel, from Europe, Switzerland. It's fantastic, and we really, really appreciate the time. So thank you all, and please be in touch. Thank you, Kfir.
Thank you very much.